Did you know that the wealthiest 1% use legal tax loopholes to save thousands, even millions of dollars every year? And here's the kicker. Most of these strategies are available to you too, but no one talks about them until now. In today's video, I'm revealing 5 tax loopholes the rich don't want you to know about in 2024. We're not talking about shady tricks or illegal practices here. These are perfectly legal strategies written right into the tax code, and I'll break them down for you in simple terms so you can start using them to save big. Quick break. If you're enjoying this video and want more tips just like these, hit that subscribe button and join our growing community. Don't miss out on the next big thing. The capital gains tax loophole. The first loophole is how the wealthy pay less tax on their investments through something called the capital gains tax. Instead of paying regular income tax, they often pay a much lower rate on money made from stocks, real estate, and other investments. Here's the trick. Holding on to investments for over a year lowers the tax rate to as low as 15%. Let's say you make $100,000 from your salary. You'd be taxed at your regular income tax rate, which could be as high as 37%. Now, if you made that same $100,000 by selling stocks you've held for a year, you'd only be taxed at 15%. That's a massive difference, and it's one of the key ways the rich keep more of their money. So, if you're investing, think long-term. This tax rate is way lower than what you'd pay on regular income. The real estate depreciation loophole. Next up, we have the real estate depreciation loophole. This one is a favorite among real estate investors. Here's how it works. The IRS allows property owners to deduct the depreciation of a property as if it's losing value each year, even if the property's market value is going up. In 2021, real estate investors deducted over $60 billion in depreciation expenses. Even though their properties were likely appreciating in value, they were claiming a loss on their taxes. Legally, if you own property, make sure you're using depreciation to lower your taxable income. Even if your property is gaining value, the IRS lets you claim it's losing value over time, giving you a huge tax break. The 1031 exchange loophole. The 1031 exchange is a way to sell a property, avoid paying taxes on the sale, and roll that money into a new investment. This allows real estate investors to keep growing their wealth while deferring taxes indefinitely. A wealthy real estate investor might sell a $1 million property and immediately reinvest in a $2 million property without paying a dime in capital gains taxes. Instead of losing 20 to 30% of their gains to taxes, they're able to reinvest the full amount. If you're planning to sell a rental property or investment real estate, consider using the 1031 exchange. This strategy allows you to keep more of your money working for you rather than handing it over to the IRS. The step-up in basis loophole. This is a game changer for generational wealth. When someone inherits an asset like a house or stocks, they get a step-up in basis, which means they only pay capital gains tax on the increase in value from when they inherited it, not from when it was originally bought. So imagine inheriting a house that was bought for $100 but is now worth $500. Instead of being taxed on $400 in gains, the new owner is only taxed on any gains made after they inherited it. This is why so many wealthy families avoid huge tax bills when passing down assets. It's a critical tool in building generational wealth and something you should consider if you're planning to leave assets for your heirs. Tax loss harvesting. This is a popular one with savvy investors. Tax loss harvesting allows you to sell investments that have lost money to offset taxes on gains you made elsewhere. This is a strategy where investors sell underperforming assets to offset gains elsewhere in their portfolio. This helps them lower their tax bill, even when the market isn't going their way. In 2020, during the pandemic, many investors took advantage of tax loss harvesting as the stock market dropped. By selling losing stocks, they offset gains from other investments, reducing their overall tax bill significantly. Even if some of your investments aren't doing well, there's a silver lining. By strategically selling losing assets, you can reduce your taxable gains and reinvest in the market for future growth. To recap, we covered 5 powerful tax loopholes: the capital gains tax, real estate depreciation, the 1031 exchange, the step-up in basis, and tax loss harvesting. These strategies allow the wealthy to save thousands, even millions on taxes every year. And now, you can use them too. If you're serious about building wealth, understanding these tax strategies is crucial. I've linked some free resources and tools in the description that can help you start applying these loopholes in your own financial life. Also, if you want more in-depth videos on any of these strategies, leave a comment below and let me know which one you'd like me to dive deeper into. Don't forget to subscribe and hit the notification bell so you don't miss out on the next video, where we'll uncover even more secrets of the wealthy.